Hey everyone. So recently Nestle announced January 5th as the date for its stock split, which is happening after nearly 2 decades. The split will happen in the ratio of 1:10, which means that one quantity of the stock before the split will convert to 10 quantity of stocks after the split. The stock split is expected to increase the liquidity and affordability of Nestle India shares, which are among the most expensive on the Lal Street. Right now, the current market price of Nestle is at an all-time high of 26,580 rupees. So now let's go ahead and analyze the company in detail and look at its strengths and weaknesses. Nestle began trading operations in India in 1912 and later commenced manufacturing operations in 1961 by setting up a plant in Moga, Punjab. The company manufactures products under four categories: milk products and nutrition, powdered and liquid beverages, prepared dishes and cooking aids, and chocolates and confectionery. It has 9 manufacturing facilities in India in the states of Haryana, Karnataka, Goa, Tamil Nadu, Uttarakhand, Himachal Pradesh, and Gujarat. So now let's go ahead and look at the strengths of this company. So Nestle India is a leading player in the Indian FMCG industry with established market position in most product categories that it is present in. The company has a range of products under the Maggi brand. It is among the top 2 players in most of its product categories, including milk products and nutrition, beverages, prepared dishes, and cooking aid. In these segments, Nestle benefits from its well-established brands. So now talking about its revenue, it is diversified as of September 2023, with 41% of the revenue generated from milk and nutritious products, which are the dairy products and weaning foods, 11.1% from powdered and liquid beverages, around 32% from prepared dishes and cooking aids, which is under the Maggi range, and around 17% from chocolates and confectionery, which include Kit Kat and Munch. So the company has launched over 125 products since 2016, with around 10 projects in the making. The revenue contribution from the new products increased to around 7% as of September 2023 from 1.5% in 2016. Now, most of Nestle India's brands are part of the parent's international portfolio. The company enjoys access to its parent's proprietary technology and strong research and development capabilities. So the Switzerland-based Nestle holds around 63% stake in Nestle India and is the world's largest player in the food and beverages sector. Next, Nestle has shown a healthy financial risk profile. The financial risk profile is robust, supported by strong operating cash flow and comfortable capital structure. Despite volatility in raw material prices, changes in the product mix and prudent cost management have ensured a stable operating margin of roughly 25%, resulting in sustained strong cash flow. Nestle India has announced its intent to incur around 5,000 crore rupees capex till 2025 to further expand its product portfolio, set up new plants, and make suitable acquisitions. This is expected to be funded through a mix of external borrowings and cash accrual. It is currently setting up a new unit in Odisha, its first manufacturing facility in East India, at a total cost of roughly 900 crore rupees. So now let's go ahead and look at the weakness that this company has. So it is susceptible to intense competition, as the domestic FMCG segment is highly competitive with the entry of new players, including multinationals in various divisions such as instant noodles, packaged foods, beverages, chocolates, and confectionery. So the competition keeps increasing owing to aggressive product launches, evolving consumer preferences, and strong marketing strategies adopted by players. So now let's go ahead and fundamentally analyze this particular stock. So right now it's trading at around 26,500 rupees and its P ratio is 88.6. So let's go ahead and look at its price chart. So it has been consistently growing and it has been on an upward trend since 2022. And its P ratio has been moving a sideways sort of trend, and it's actually quite okay in this industry. The P might seem very high, but in the FMCG industry, it is normal to have such high P ratio. So let's go ahead and look at its profit and loss statement. So here you can see that the profits, they were, in a sideways trend till around 2017. But from then it has been increasing, and this particular year, trailing 12 months, it has had a profit of roughly 3,000 crores. So yeah, it's a pretty good growth rate. But again, as we already talked, in the analysis, that there is competition from small players, from new players, who enter this market. But again, it has an established position in the market already, so it still makes sense to hold the stock. So let's look at its sales growth. Sales growth has been at roughly 11% for the last 3 years, which is decent. It's not a very good sales growth, but it's fine in this industry. So we'll go ahead, look at the shareholder pattern. So it's roughly 63% for the promoters, which is good enough. That means that the owners have the skin in the game. So let's go ahead and look at its rating update from CRISIL, and it has a AAA credit rating, which is the highest credit rating that a company can get. So it's pretty good, in the sense the fundamentals. If you look at the fundamentals, they have no apparent red flags. It's a very good stock. The industry is growing, the fundamentals are good. So it makes sense to buy this stock right before the split. It is expected that the stock will be in an upward trend once again, and the operating performance is still expected to be healthy in the upcoming year 2024, with estimated early double-digit revenue growth and operating margin of roughly 25%. In the year 2023, its revenue grew nearly 15% year on year. So we can still expect the operating margin to improve in the upcoming year. And just the fluctuations in the input cost will be a key thing to monitor. Other than that, the industry is pretty good. The stock seems, really good fundamentally, and there are no red flags as such. So that's all for this analysis. I'll see you guys in the next video.